Hi everyone. Before I start this video, make sure that you're part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025, May-June, Paper 3-2, question number 3. This is structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for the paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 3 under 30 minutes. So without any further delay, let's get started. Ahmed and Betty were in partnership for many years, but they did not have a partnership agreement. The partnership statement of financial position at 31st December 2024 was as follows. We have non-current assets, and in this case, we only have tangible non-current assets. There is no mention of any goodwill. Then we have current assets, capital account, current account. We have one non-current liability, loan from Betty. Then we have trade payables as our current liabilities. Betty retired on 1st January 2025 and Chandra was admitted as a partner on the same date. So this is a combination of two different partnership changes. We have admission of a new partner because Chandra is being admitted. Then we have retirement of an existing partner as well. Betty is retiring and this is on the same date. Ahmed and Chandra agreed to share profits and losses in the ratio of 3:2. Previously, there was no partnership agreement, which means that Ahmed and Betty had been sharing profits and losses equally. The following arrangements had also been agreed by all of them. Assets on 31st December 2024 were revalued as follows. So equipment, motor vehicles and inventory are being revalued. Goodwill at 31st December 2024 was valued at 90,000. No goodwill account is to be maintained in the books of partnership business. It means that we need to make adjustment for goodwill within the partner's capital accounts. We need goodwill based on the old ratio on the credit side of the capital account, and we need goodwill based on the new ratio on the debit side of the capital account. Then the amount owed to Betty was settled in full on 1st January 2025. So now, while preparing our capital account for Betty, we will not have any balance CD because she is retiring. So any amount due to her will be paid. So we can write it under the heading of bank or cash. Then Chandra introduced cash to pay for her share of goodwill, contribute capital so that the capital account balances at 1st January 2025 are in the profit sharing ratio, and make a loan of 40,000 to the partnership. Alright. Ahmed introduced cash to pay off his current account debit balance. So for Ahmed, we have the current account debit balance of 9,500, and this is the exact amount he introduced. Let's take a look at our first question. We need to state two reasons why a business may have goodwill. So goodwill can be created due to favorable aspects of the business. So the first one could be that it has a large number of loyal customers, or it could have a good relationship with suppliers, or it might be located at a very prime location, or they might have efficient and experienced workforce. So we can write any of those reasons. Let's write has a large number of loyal customers, or they might have experienced and efficient workforce. Then for the second one, we need to state one reason why Chandra has to pay for the goodwill. So Chandra is the new partner being admitted, and she will have to pay for the goodwill because all the goodwill existing in the business are generated due to the efforts of the existing partners. So any new partners being admitted will have to pay in order to reward the existing partner for their efforts in generation of goodwill. Let's write it down. To reward the existing partners for their effort. State three reasons why goodwill account is not maintained in the partnership's books. Okay, the first thing you need to understand is there are two different types of goodwill. The first one is inherent and the second one is purchased goodwill. So purchased goodwill will only arise when there is business acquisition. Whenever you are purchasing a goodwill, you might pay extra amount, and since you have an objective value for it, you can record it within your books of accounts. But inherent goodwill is something that you just come up with. It is subjective, and it might depend on partner's perspective of the business as well. Since there is no concrete value for inherent goodwill, it should not be maintained in the partnership's books. That is the very first reason. Let's write it down. The goodwill is inherent. Then the second reason is because the valuation of goodwill is subjective. Like I said before, Emmett might argue that the goodwill of their business is 80,000 and Betty might argue that no, it's instead 85,000. And there is no fixed formula to calculate the correct amount of goodwill. That's why it should not be mentioned. Let's write it down. The valuation of goodwill is subjective. Then for the third reason, we can also put in our accounting concept. So of course, prudence concept will be there. It states that the assets of the business should not be overstated. And we know that goodwill is part of our non-current asset. So if we do not maintain it in the partnership's books, it means that we are avoiding the overstatement of assets. Let's write it down. According to the prudence concept, assets of the business should not be overstated. Okay, that is all for the second part. Now for the third one, we need to calculate the amount payable to Betty on 1st January 2025. So you can either create a statement or you can just create your capital account. And in this case, remember that Betty is the retiring partner. So there will be no balance CD. Instead of balance CD, we might write bank, and that will be the amount payable to Betty on the date of retirement. Okay, we'll start with the opening balance, which will always appear on the credit side. Let's take a look above. For Betty, the capital account is 180,000. Then for the retiring partner, we should also close their current account. So we need to adjust the current account balance as well. And in this case, current account for Betty is positive, which means that it will appear on the credit side within the capital account. If it were to be negative, then we would have to enter it on the debit side. So we have 5,500 as part of the current account. Okay. And in this case, Betty also provided loan to the business. And we were told that the amount owed to Betty was settled in full, which means that we also settled the loan amount. So the loan amount was of 15,000, and since now Betty is going to receive back this 15,000, it will increase her capital balance. So we need to write down the 15,000 on the credit side. So that is the loan of 15,000. Then we were told that goodwill is not to be maintained in the books of accounts. And in this case, we need the goodwill old ratio on the credit side, new ratio on the debit side. And new ratio will appear for our new partner, which is Chandra in this case, and old ratio will appear for the existing partners, which will be Ahmed and Betty. And after retirement, Ahmed is still in the business. So the new ratio goodwill will be divided among Ahmed and the new partner Chandra, whereas the old ratio will be for Ahmed and Betty. So we need to figure out the value of goodwill based on the old ratio for Betty. We can see that the goodwill was valued at 90,000 and previously there was no partnership agreement. So Ahmed and Betty will have half of this amount, 90,000. So Betty will have the value of 45,000. Old goodwill will always appear on the credit side. Let's write it down. So we have goodwill 45,000. Okay, now another thing that the existing partner will have to account for is the profit or loss and revaluation. And the revalued assets are right here. So let's calculate the new amount, 161,000 plus 117,000 plus 105,000. This results in 383,000. Now the previous values, that's for equipment, motor vehicles and inventory. That is 185,000 plus 148,000 plus 82,000, which results in the value of 415,000. So this is the old value. New value after the revaluation is 383,000. So we can clearly see that there is revaluation downwards, which means there will be loss on revaluation. So that will just be 415,000 minus 383,000, which results in the value of 32,000. And any profit or loss on devaluation will only be divided among the existing partners, which in this case is Ahmed and Betty. So Betty will have to bear half of this loss. That will just be 32,000 divided by 2, which is 16,000. And this is loss on devaluation, which will reduce her capital balance. So it should appear on the debit side within the capital account. So we have 16,000 as loss on revaluation. Now we just need to figure out the closing balance, but since Betty is the retiring partner, there will be no balance CD. Instead, we have to write down bank because all of the amount are being paid. Now the total from our credit side is 180,000 plus 5,500 plus 15,000 plus 45,000, which results in 245,500. So the amount payable to Betty at the date of retirement will be 245,500 minus 16,000, which results in 229,500. We can write that down separately as well. Amount payable to Betty on 1st January 2025 will be 229,500. Alright, that is all for the third part. Let's move towards the next one. We now need to calculate the amount of cash introduced by Chandra on 1st January 2025. So we just need to figure out the total amount she introduced. You can create a statement for this one. We were given the criteria clearly right here. She will pay for her share of goodwill. This is her new goodwill value. And we know that the total amount for goodwill is 90,000. And we need to divide it based on the new profit sharing ratio, which is 3:2. 3 parts will belong to Ahmed, 2 parts will belong to Chandra. So the goodwill value belonging to Chandra will just be 90,000 times 2 by 5, which results in the value of 36,000. Let's start there. That is the goodwill. 36,000. Then she will contribute capital so that the capital account balances at 1st January 2025 are in the profit sharing ratio. Okay, so in order to make the capital account balance reflect their profit sharing ratio, we first need to figure out Ahmed's capital account at the date of 1st January 2025. So I'm just going to prepare Ahmed's capital account roughly right here. We can start with the opening balance. That is 250,000. So that's the balance BD 250,000. Then we've already calculated the loss on revaluation. That is to be shared by Ahmed and Betty equally. So that is 16,000 for Ahmed. That will appear on the debit side because it will reduce the capital balance. So this is loss on revaluation. Then we need goodwill old ratio. Old ratio was just half. So half of 90,000 will just be 45,000. Then the goodwill new ratio will be based on the new profit sharing ratio. So 3 parts out of 5 parts will belong to Ahmed. That will be 90,000 times 3 by 5, which results in the value of 54,000. So this will appear on the debit side. And for the very last information, we were told that Ahmed introduced cash to pay off his current account debit balance. So now his debit balance will be 0 because the introduction of 9,500 will get cancelled out with this negative balance of 9,500. And this will not appear within his capital account because that is not the extra cash introduced to the business. It is just the cash he is paying back to cancel off his current account debit balance. So we can now figure out the balance CD, We first need the total from our credit side, 250,000 plus 45,000, which results in 295,000. Then the closing balance will be 295,000 minus 16,000 minus 54,000, which results in 225,000. So this is Ahmed's capital balance at the date of 1st January 2025. Now we need the value for Chandra so that their capital account balances are in the profit sharing ratio. So the profit sharing ratio is 3:2. So 3:2 should reflect 225,000 is to the capital that should be introduced by Chandra. So we can just solve it. 3 by 2 will be equal to 225,000 divided by C. The value for C will be 225,000 times 2 by 3, which results in 150,000. So this is the value that Chandra introduced. Let's write it down. So that is the capital account, 150,000. Then there's one more item. Chandra will make a loan of 40,000 to the partnership. So she is introducing additional 40,000 in cash as well. This is the loan. And remember, in this case, we are calculating the amount of cash introduced by Chandra, not the capital account balance for Chandra. The capital account balance for Chandra will be equivalent to 150,000. So that is the amount that will appear in the statement of financial position under the heading of capital. Remaining value is just the cash that is being introduced. Let's figure out the total. So that is just the cash introduced by Chandra. 36,000 plus 150,000 plus 40,000, which results in 226,000. So the value of cash will now increase by 226,000. That is all for the fourth part. Let's move towards the next one. We now need to prepare the statement of financial position of the new partnership at 1st January 2025. Okay, this is the statement of financial position at 1st January 2025. Let's start with non-current assets. And the assets were revalued in this case, so we need to include the revalued amount. We had two different non-current assets, equipment and motor vehicles. And I think both of it were revalued. So we can just refer to the new amount. Right here, the new amount for equipment is 161,000 and the new amount for motor vehicle is 117,000. Let's write it down. So 161,000, 117,000. And there will be no goodwill in this case because it is just the inherent goodwill which should not be maintained in the partnership's books of accounts. Now we need the total of the non-current asset, 161,000 plus 117,000, which results in 278,000. Now for the current assets, let's take a look above. Inventory was revalued, so we need to include 105,000. Let's write it down. After inventory, we have trade receivables. So there is no adjustment to be made to trade receivables. We can include the value of 76,500. Okay, then the last value was of bank. We need to make adjustment to bank. So initially, this is before the retirement and admission, we have the value of 20,800. Then we were told the amount owed to Betty was settled in full. So we paid all of that from the business bank account. And the amount that we had to pay was 229,500. So this will reduce our bank balance, 229,500. Then we were also told that Chandra introduced cash to the business. And the total cash that she introduced was of 226,000. This will again increase the value of bank balance. Let's add it. Plus 226,000 And then Ahmed also introduced cash to pay off his current account debit balance. His current account debit balance was 9,500. So that will also increase the bank balance. Now, the total value that we should show under the heading of bank within our statement of financial position at 1st January 2025 will be 20,800 minus 229,500 plus 226,000 plus 9,500, 26,800. Let's write it down. This is for bank. Now we need the total of our current assets. That will just be 105,000 plus 76,500 plus 26,800, which results in 208,300. Now we need total assets. That will just be 278,000 plus 208,300, which results in 486,300. Okay, now we can move towards the capital section. We have Ahmed and Chandra because Betty retired. And we need to include the new value of the capital accounts. So the capital value for Chandra will be 150,000. Then we've also calculated Ahmed's capital value, which is 225,000. Let's write it down. So 225 for Ahmed, 150 for Chandra. And the total capital will be 225 plus 150, which results in 375,000. Then we also have a non-current liability, which in this case was the loan introduced by Chandra. Right here, the loan amount is of 40,000. Let's write it down. That's the loan from Chandra, 40,000. Then we have one more current liability. That was just trade payables. And there is no adjustment to the value of trade payables. We can just include the previous amount. That was given to be 71,300. Let's write it down. Okay, now we can calculate the total capital and liabilities. That will just be 375,000 plus 40,000 plus 71,300, which results in 486,300. And the total capital and liabilities is equal to the total assets, which means that our statement of financial position is correct. That's all for the fifth part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.